Okay, good morning. Today, before we get started, we don't have a question right now on Learning Catalytics, but you can feel free to log in. Well, our first question will come up in a few minutes, not immediately. But I wanted those of you that are in the classroom got accosted by Nicole Cotlin in a good way. There is a job and internship panel Wednesday this week from 12 to 1 in the Entrepreneurship Lab. It's typically for sophomores, and if you're one of the first 20 people to arrive, and you're a sophomore, where's the camera? You get this cool T-shirt. Okay, so if you want me to show you the T-shirt, and there's a panel. You do not have to dress professional for the event. Just come as you are. And there's a panel about preparing for your job and internship search. And one of the panelists this week is Adam Martinson, who you don't know, but he was my GA a couple years ago, and he's a lot of fun, and he's really cool. And if you can do this, it's 12 to 1 this Wednesday in A123 in this building, the Entrepreneurship Lab. There's also one Tuesday next week from 5 to 6, same place. So if you're interested, if you're a sophomore, these are aimed for sophomores. If you're interested and didn't catch that detail, email me and I'll put you in touch with who you need to know for that. Okay, so now on to announcements for this class. The Saturday this week, all sections have Chapter 7 homework due, and if you're in Section 3, you have a quiz in addition to Chapter 7 homework. Exam 2, high points. We're going to talk about this every day for the next 2 weeks. I apologize for my redundancy, but I want to make sure everyone gets it. Our next exam is Monday, October 27th through Wednesday, October 29th, finished by 8 p.m. Now this is not next week, but the following week. Now you'll see that I switched between finishing by 8 p.m. and by 9 p.m. I do not want anyone thinking they can finish at 9 p.m. It submits automatically no matter what. And if you're saying, oh, I'll just buzz in there at 8 p.m., it turns out good. So you'll see I'm encouraging people to finish by 8. Okay, sections 3, 7, and 8, schedule with ProctorU soon so you get your choice of appointments. I sent you out an email last week urging you to schedule. You have to schedule at least 72 hours in advance, but time slots get taken. The more desirable time slots get taken, so schedule early. We do have another 10-point bonus if you take the exam Monday, October 27th, and finish by 9 p.m. It is available. She's saying when you went to schedule it wasn't available. It is available because I know people are scheduled for it. So in that case, if you don't see it, they have the weirdest sorting algorithm. It isn't sorted. Okay, so if you get in, and I get these emails, this is probably my most popular email about it's not available to be scheduled. So what I would tell you to do is call on the phone, talk to a person. Just call ProctorU, schedule that way. Also, what kind of class you pick when you're picking, when it says is this an online class or not. I think you have to pick the other one. That maybe that's what's narrowing it down. But anyways, if you have any trouble scheduling, I would just say pick up the phone, call them, and they have the goofiest sorting I've ever seen. So anyway, so do make sure you get that scheduled. 10-point bonus. And now for all the detailed information. Okay, the chapters on this exam, chapters on exam 2. Okay, so okay, are 5, 6, 7, and 8. I have 4 with an asterisk because next week when we do Chapter 8, which is a really little chapter, we're also going to put one concept from Chapter 4 next week, and bank reconciliations. So we have bank reconciliations from Chapter 4 and then Chapter 8, which is fairly small. So this list, even though it looks like 5 chapters, it's really under 4 because 8's really small. So we have 5, 6, 7 are the big ones, and then we have 8, and then we have a chunk from Chapter 4. Okay, 4 and 8 are next week. Okay, time zones. All times are stated in Eastern Standard Time. Someone just said there's no times left for Monday with ProctorU. Again, if you want it Monday, I would call them on the phone. The phone gets you things that maybe they don't have scheduled yet. And I would call immediately, and if they have enough demand, they may open up more time slots. So call on ProctorU if you're not seeing any slots available. So call and work with them. Okay, sections 1 and 2, again, these are the same rules. I'm not changing anything from the first exam. Take your exam in the computer lab. You have to start by 7 to be allowed to take it. And lines could be, at this point I don't know if any other exams are going on for our next one. I would assume there are. Okay, sections 3, 7, and 8, again, ProctorU. Call them if you're having trouble scheduling. I wanted to make a note. I wanted to thank everyone. The first exam, I will tell you that absolutely no incidents of cheating were reported for my class. Yay. So thank you. That's always, I hate cheating more than anything. It's heartbreaking because I have to report it. I'm not going to risk my job for someone's cheating. I have to report it, and it's always heartbreaking because it's never a good situation. So the first exam worked well, so good job. So everyone did what they needed to do. Exam basics, same thing, 120-minute time limit. The average is going to be anywhere from 45 minutes to an hour. This exam is probably going to take you a little bit longer than the first exam, just because some of the things we do, like depreciation, which we'll start on Wednesday, takes a little more time than what we did in the beginning. There are 4 exercises on the exam, roughly 28% of your exam. It says 25 here, but I just did the exam yesterday, so this is fresh in my mind. So there's 4 exercises, 28%, and then a series of multiple choice questions, around 25 of those for 72%. 1 page of notes, 1 physical page of notes, front and back. You can do anything you want to it. Has to be readable by the naked eye, no magnifying glass. 10-point bonus. So as I mentioned, there is a 10-point bonus on this exam. You have to take it Monday. It has to be submitted by 9 p.m. Monday Eastern Time, and you have to hit that submit button and have it submitted before 9 p.m. Your score will be added sometime Monday night to Tuesday morning, somewhere in that time frame. Chances are it's going to be added Monday night around 9:05 p.m. And when you finish your exam, just like the first exam, you finish your exam on Monday, that score does not include the 10 points. I manually add that. Okay, and the bonus offer is only for Monday, so you have to take the exam on Monday to get the 10 points. And again, if you're trying to schedule for ProctorU, I would urge you to try to schedule today, okay? And if they're showing no appointments, you get on that phone and you call them, and if enough people call, they will open up more time slots. My experience has been in the past, but you can't call them Sunday next week and expect them to open up time slots. So the more people that call, the better, and we can get the time slots. And I will try to remember later. I'll see if I can send an email and make a request too, just to let them know. Okay, no curve on the final, or on the exam or final. By the way, the final exam, there'll be a 10-point bonus available on the final exam, but it will be for Sunday before finals week. So you'll be able to take for the 10-point bonus on the final will be if you take it Sunday. So we will have, and we'll get to that closer. I just wanted to get that on your radar. Okay, detailed exam information. This was wonderful. On this exam, on this first exam, the couple times where people had issues during the exam, they did email me and we were able to resolve it right away. So if there's any issue during your exam, contact me immediately. Even if the proctor says, I'll contact her for you, that exam is much more important to you than to that proctor. You don't want to wait. You don't want to let your fate rest with the proctor. So you contact me. Worked well. Again, no incidents for the first exam. This is just wonderful. So this is great. So hopefully we just continue this way. Okay, don't wait till the last day, of course. If you're in sections 3, 7, or 8, you have to start your exam by 4 p.m. We do that because sometimes you have to troubleshoot, sometimes you have to find you know, it's the exam, Murphy's Law, everything that can go wrong will go wrong. So I found if we start by 4 p.m., we get done in time. Sections 1 and 2 start by 7 p.m. Wednesday. That exam is going to submit at 9 p.m. Wednesday no matter what, so you need to get in there. If you're registered with SAS, I would have contacted you via email yesterday if there was anything I needed from you. Know your My Accounting Lab login. Again, this is a repeat of the first exam. There is an exam info quiz. This should be the easiest quiz you do all semester. It's 5 multiple choice questions. It's beginning available in My Accounting Lab beginning Sunday, October 19th. And it's just about information about the exam. And again, you have maximum 2 attempts. It should be really easy. And that's in there. I just did it yesterday, and it's ridiculously easy, but I just want to make sure we're all on the same page. So that's a way to get a pretty easy score. Practice exam 2 will also be in My Accounting Lab. It is going to be available starting Sunday the 19th as well. It's due by the time you take the exam, before you take the exam. It is not worth doing after you do the exam because it helps you prepare for the exam. You should be doing, you know, you should be reading your book, taking notes, making your exam reference sheet. But the practice exam, after you've done that, you take it. It's meant to be a barometer for you of how well you know the material. Your exam score should be pretty closely related to your practice exam score. There's no time limit on the practice exam, and you have all the study aids on the practice exam as well, like to help me solve this. So that will be available starting Sunday this week, and you have until you take the exam to take it. It's due before you take the exam. Okay. Okay, questions about the exam or anything? Okay then. And again, we'll talk about the exam every day, so we've got 3 more days of talking about the exam. I'll go faster over it each day, but if you have any questions, you can bring them then. Or feel free to email me. Oh, speaking of email me, the most well, not the most popular email, but what's happened frequently, I think people are thinking they'll save a step, but when you ask about a homework problem, lately I've been getting emails that said, I have trouble with the second homework problem, can you help me? Or send me a screenshot. If you need help with a homework problem, you're working on the homework problem, there is an Ask My Instructor button right there. Use it because it helps you and it helps me get you the fastest answer you can. The Ask My Instructor button sends me a hyperlink to your exact problem so that I can open it. I can see the pop-ups because if you do a screenshot, it doesn't give me all the information I need. So I can mouse over things and see what's going on. So 2 things. Use the Ask My Instructor button, and also tell me how you're getting the number you're getting. Because you'll say, I can't get the right number, what am I doing wrong? I don't know, but if you tell me I'm adding 25 plus 6, subtracting 7, or something like that, I can pretty quickly figure out where you're veering off course there. So use the Ask My Instructor button and put in what you're doing so then I can figure out what you need to be doing differently. And it makes it so much faster because if you don't use the Ask My Instructor button, you're going to get an email back from me that says use the button so that I can see it because everyone's homework problems are different. So that's the fastest way to get homework questions answered. So if you start with that, that's going to be helpful for both me and for you because you're going to get a faster answer and a more direct answer. Okay, so now we're on Chapter 7. Chapter 7 is about long-lived assets, assets that hang around for a long time that are used productively in our business. For example, let's say we buy a delivery truck to be used in our business, and this delivery truck costs $30,000. So this $30,000 delivery truck I buy today, I'm going to use it for 5 years. So I could, in theory, I could say I spent $30,000 cash today. I'm going to have delivery truck expense today. Well, that fails because the $30,000, if I put it on expense today, if I say delivery truck expense, then my $30,000 goes into my income statement this year, and that's it. But I'm using this delivery truck for 5 years. Why is it fair to have $30,000 put all in this year when I'm actually using the delivery truck over the next 5 years? So we have this process of taking these assets that we buy for use in our business. This is not inventory, by the way. This is things that we use, like equipment, buildings, things that we use in our business. In this case, 5 years. I'm going to use this delivery truck over 5 years. So what I'm going to do is I'm going to take the cost of the delivery truck, basically, and divide it over all the years I'm going to use it. So then what I'm doing is I'm matching the cost that I'm incurring with the revenue I'm generating. So hopefully when I buy assets, they're ultimately to support the revenue generation. So I want to spread that cost, allocate the cost over the life of the asset I'm buying. That's what this chapter is about. So those are plant assets. Plant assets are things I can touch, I can see, and they are things that have a long life, typically a big price tag usually, and they last for more than a year, and they're used in our business. So those are plant assets. Natural resources are things that we get out of the ground or the earth. So it would be timber, it would be gas wells, it would be salt mines, things like that. Those are natural resources. And then finally, intangibles. Intangibles are things like patents. We hold a patent, and it's going to benefit us over the next 8 years or whatever it might be. So that's what this chapter is about. How do we deal with those? So we start with plant assets. So everything we do today is about plant assets. So these are the physical assets. These are buildings, land improvement, equipment, automobiles. Those are all plant assets. So when we talk about these things, we have plant assets. Example, this is Exhibit 7-1 in your book. By the way, we have a lot of writing today. You're probably not going to be able to write every word down, nor do you need to. The PowerPoints are on Blackboard, so you'll be able to write most of them down. But in case you don't, this is Exhibit 7-1 that's in your textbook. We have balance sheet accounts. Those plant assets are things like land, buildings, equipment, furniture and fixtures, land improvements. Those are examples. That's not a complete list, but those are things that are plant assets. When we have them, the related expense account is depreciation expense. Something to note here that when we talk about land is an exception. Land has no expense account because land never gets depreciated. We'll see that again later. Okay, but we have depreciation expense for all our other plant assets. Then when we get down to natural resources, we'll have something called depletion expense, and intangibles have amortization expense. Again, we'll see both of those terms on Wednesday. But today we're going to focus on this idea of depreciation, and that's we buy this something, we purchase it or we construct it. So we have the cost of the plant asset. How do we spread it over the cost, over the life of the asset? So today we're going to focus on terminology. We've got a few little computations, but the depreciation methods will be on Wednesday. Okay, now when we have plant assets, we have different costs. That we have the cost of an asset. Obviously we have the purchase price, but we have other things that go into the cost of our asset, including taxes, commissions, any other amounts paid to make the asset ready for use. This working rule, it's the sum of all costs incurred to bring the asset to its intended use. So that's basically the rule of thumb when we're talking about measuring the cost. Samantha, it sounds like you're not logging in correctly. I mean, with the right login. That's typically what you see there. Unless she's using, I think she's using Safari, because then she used Firefox. That's only if she is using Mac. And she can, she can also log directly into Learning Catalytics. Just Learning Catalytics, log in with her My Accounting Lab, and that'll get her past that issue for today. Okay, so the sum of all the costs incurred to bring the asset to its intended use. Okay, Land. Land is a special case. Land is never ever depreciated. When we talk about the cost of land, it's going to include the purchase price. Purchase price can be cash, it can be notes payable. It doesn't have to be just cash, but cash and notes payable. Any commissions we pay for, survey fees, legal fees. If we paid back property taxes, if the seller was behind on taxes, you have to pay the taxes before you get the property. That's part of the cost. And then this last one, expenditures for grading and clearing and for removing unwanted buildings. Okay, so all the costs get ready for use. So notice that we're grading and clearing. We are just getting the land back to normal use. If this Notice that this does not say digging a foundation. If you're digging a foundation, you're actually building the building. So just a little distinction there. Okay. Okay, so let's go through an example. So we have FedEx signs a $300,000 note payable to purchase 20 acres of land. They also pay $10,000 for real estate commission, $8,000 of back property tax, $5,000 for removal of an old building, $1,000 survey fee, and $260,000 to pave the parking lot, all in cash. So we have $300,000 note payable and then a bunch of cash items. So the question is, what's the cost of this land? So we run through here. Basically, we have the purchase price. So yeah, purchase price is part of the cost of the land. That's the easy one. Now working our way through the rest of these things. Real estate commission absolutely is part of the cost of the land. Back property taxes are part of the cost of the land, so we have another $8,000. We have $5,000 for removal of old buildings. We have a $1,000 survey fee. So far those are all pretty standard. They were on our list. Now we get down to the bottom, $260,000 to pave the parking lot. Okay, land is everything to get it ready for use. A parking lot is actually an asset of its own. It wears out. It does not have the same indefinite life that land does. So it is not, that parking lot is not part of the cost of the land. So that parking lot is actually something called land improvement, which is depreciated. But a parking lot, you think about it, parking lot wears out. It has to be repaved. It's not going to have that same indefinite life as land. So the cost of this land though then is $324,000. So we add up everything except the paving of the parking lot. Now the next slide is going to say what do we do for the journal entry for this. Something before we leave the screen I want to point out. They have a note payable for $300,000. Okay, and then it says cash for everything else. So when we're looking at, we have a total cost of land of $324,000. $300,000 is a note payable. So then we know $24,000 has to be cash, just going forward. So next one, recording the purchase of that land. So what happens when we buy the land? Well, first of all, we have an asset called land for $324,000. That's our total cost, which we just calculated. So land is increasing, land is an asset, so we're going to debit it for $324,000. Notes payable, $300,000. We were given that in the first slide, note payable. And then the remainder was cash for $24,000. Okay, so we've got, that's what happens when we purchase something. We're going to increase the asset, and then we're increasing the liability or reducing cash to pay for it, or some combination. Okay, land is never depreciated. That's why you have to be very careful about what's in land versus what's not in land. Okay, buildings, machinery, equipment, things like that. We have costs of constructing. We can construct a building or we can purchase it. If we construct it, it's going to be our architecture fees, building permits, contractor charges, labor, material, overhead. I'm also going to include interest on the money used to finance the construction. So everything up until the building's put into use gets to be added as part of the cost of the building. So the cost to construct, the cost to finance it up to the point of use. Down below, the cost of purchasing a building includes everything we had before, the purchase price, brokerage commission, taxes paid. And then if we're going to renovate the building, so we buy a building, and let's say we have to go through and retrofit it for our purpose, all those costs up until the point it's in service are included as part of the cost of the building. Why do we care if it's part of the cost of the building or not? Everything up until we put it into use gets put as an asset, so it doesn't hit our income statement until we spread it out over its life. Now, if we pay for it after we put the building in use, there's a chance it'll go on the income statement and reduce our income immediately. So it has an income statement impact. So we want to make sure we understand what has an income statement impact, what does not. I would definitely use the chat window for Pearson because sometimes that's easier than the phone call. There's also a chat window, that's another option. The chat window is 24/7 also. Okay, we also have things called land improvements and leasehold improvements. Land improvements are things we do to the land after we get it ready for use. So it's things like parking lots, fences, lighting, sprinkler systems, anything we do to improve the land is something called land improvements, and it can be depreciated as well. Leasehold improvements, a lot of times as a business we have a lease for 30 years and then we do things. So we might lease land for 30 years and we put a parking lot on it. The parking lot is considered a leasehold improvement and we can depreciate it. Just because we don't own the land behind it, we can still depreciate it. Okay, we are going to do a series of questions in Learning Catalytics right now. The link's on Blackboard. Okay. Okay, we're going to do a Learning Catalytics question now. So you want to make sure you get signed in. The question is showing in the PowerPoints now, but it is in Learning Catalytics. The session ID is in the chat room. It's 1136-1741. And again, you can go directly to learningcatalytics.com, log in with your My Accounting Lab information, and you can get directly into that. I'm talking to you, Samantha. Okay, the cost of land may include the cost of any back property taxes that the purchaser pays. True or false? And again, this is always participation until I tell you otherwise. I'll give you a warning ahead of time if we choose to do that. I would assume it saved it from a prior time. Yeah. Can you answer the question, Samantha? Great. Okay, so you're good. So that's what you have to do today, Samantha, to get through today. Okay. Okay, we're going to close this question in probably 10 seconds. So again, true or false? You guys are all set over here? Logged in? Okay. Over here, anybody having trouble? What? Pardon me? Okay, log out. Completely log out and then log back in. Who else had their hand up? And we're going to go on, but right after class, come on down and give us your name. Okay, but you should be fine for the next question. Okay. Okay, it is true we're going to include the back property taxes in the cost of land when we buy the land. Okay, next one. Land improvements are not subject to depreciation. Is that true or false? Natasha, can you tell her she can log into Learning Catalytics and tell me which time she attended, because she can review her results. Yeah. And that would be an email to me. But she has to tell me the time, and she has to go into Learning Catalytics and tell me how many questions she answered. She can review her. If it's in Learning Catalytics, she's good. Okay. Land improvements are not subject to depreciation. True or false? Okay, did you get into it? Mm-hmm. Hit refresh just for a second. You know what I would do? Okay, good. See, it knows I'm standing here. Yeah. Okay. But do come down after class so I can get your name. Okay. Okay. 5 seconds. No, it wasn't a recording error. It'll be something else. Okay. No errors. Okay, land improvements are not subject to depreciation. 5 seconds. We're going to close this. Okay. Okay, false. We can depreciate land improvements. We just can't depreciate land itself. One more. Wait, this one, right? Which one are you on? This one? That one? Okay. Okay, another one. We have one more after this one. Okay, Company A purchased a used piece of equipment. All the costs should be included in the cost of equipment except for, Alec, if you can't submit your answer, you need to tell us right then in the chat room, right then. But, I mean, Haley's writing it down now, but if you have problems, we need to know right then in that 5 seconds that we're saying. We don't know which question. Okay, 5 seconds. Anyone? Okay, maintenance costs. After the equipment up and running, maintenance costs are not part of the piece of the cost of the equipment. Okay, another one. Company B purchased some land, is preparing the land for a new building. Which should be included in the following costs of land? Cost of driveways, cost of fencing, cost of sprinkler systems, or cost of grading and clearing the land? Right? Yeah, because we didn't. Right, we haven't done this. Oh, right. Oh, we have. Is this right now? Okay. You can be track of the order, right? Okay, because we have one at the end. Yeah, I. Okay. Okay, Company B purchased some land, is preparing the land for a new building. Company B should include which of the following the cost of the land? 5 seconds. We're going to close this one. Make sure you get your answer in. Okay. Okay, grading and clearing the land is included in the cost of land. Everything else is considered a land improvement. And then we have one more before we get on to some homework. Just tell her to answer the last question, then she could class connect. I don't know. Okay, land is purchased for $543,710. Back taxes paid by the purchaser were $8,500. The cost to demolish the existing building and clear the land were $215,000, and cost of paving the parking lot were $106,000. Okay, so you're coming up with a total for cost of the land. There's no sound because I was waiting for people to finish. Okay, 5 seconds on this one. So get an answer in, even if you're not done, if you're still adding, submit an answer. Cost of the land was C. How we got that was the land purchase price of $543,710 plus $8,500 back taxes plus total cost to demolish $215,000. The paving the parking lot is not part of the cost of land. That's a land improvement. That's something that will wear out. Okay, so now what we're going to do is we're going to go a little bit further in this purchase idea. Sometimes we don't purchase, many times we don't purchase just one thing at a time. Oftentimes, if I go to buy real estate, I'll buy a building and a land. We just learned we can't depreciate land, but we can a building. So we have to allocate the purchase price between the two items. So what we're doing now is called a lump sum purchase. This is when we purchase several assets at one price. And if we get the individual market values, they don't add up to what we purchased it for. There'll be more. You know, if you buy a bunch of things at once, they'll lower the price, you know, a combo. So you say, oh, if you buy all three things, I'll give it to you a little bit lower. That's what happens. So we appraise the land, we appraise the building, we appraise the equipment that's in there. They come up a little bit higher than our purchase price. So what we need to do is we need to allocate the cost based on the market value. This is called the relative sales value method. We're going to be going through short exercise 7-2 to illustrate this. Okay, so relative sales value method, we're going to go through an example here. Okay. Short exercise 7-2. It tells us that the company paid $320,000 for a group purchase of land, building, and equipment. So that was the cash paid. We paid $320,000. Now that at the time of acquisition, the land had a market value of $112,000, the building's market value is $225,500, and the equipment's market value is $10,500. So if I add those market values up, they equal $350,000. So I have $350,000, but I only paid $320,000. So the challenge is, what do we value the land at, the building at, or the equipment at? So we have to allocate that $320,000 to each of those items based on this relative sales value. So the first thing I'm going to do is that land. That land has a market value of $112,000. So I'm going to take the $112,000, divide by the $350,000 total market value, and I get 32%. Okay, the building's total market, the current market value is $225,000. So I'm going to take the building, $225,500, divide by the $350,000 total market value and get 65%. So 65% of my purchase price was that building. And then finally we have equipment. Equipment, the market value is $10,500, so that adds up to be 3% of our total purchase price. This one, there's no rounding involved. I don't know on your homework if there's rounding or not. If there will be rounding, there'll be green instructions. Typically there's a green line before you put the things in, and it'll tell you to round to how many decimal places. Or typically it's nearest whole dollar for this stuff. And we use the 5-floor rule, meaning if it's 5 or higher, you round up. If it's 4 or lower, you round down. A quick, easy way to tell on the homework, if you're looking at it, you go, I don't know how to round, and those rounding instructions, you just can't see them. You can click on the Help Me Solve This. It'll give you a nice model for what it should look like, so you'll know by looking at that. Okay, so anyways, we have land 32%, building 65%, equipment 3%, that's 100%. Just checking to make sure we did our math right. And so now what we're going to do, okay, good question. Why does it say, I'm answering that one. Why does it say all three purchases add up to $320,000? We paid $320,000. That's what we paid. Now the market values, again, added together are $350,000. So you may have an appraised value of all these pieces of $350,000, but the seller says, you buy all three, I'll give you a deal, you get it for $320,000. So you're buying it for less than and that's very, very common. You're buying it less than its fair market values added up individually. Okay, so now what we're going to do is we're going to allocate that $320,000 to each of those assets. So $320,000 times 32% for land gives us $102,400. Building, $320,000 times the 65% gives us $208,000. And then equipment, 320,000 times 3%, 9,500, 9,600. So what I've done is I've allocated that 320,000 to each of those assets based on their market values, their relative market values. Now the problem is telling us in the last sentence, 2 sentences, it says journalize the lump sum purchase of the 3 assets and the business signs a note payable for this amount. So the business is signing a note payable for $320,000. What we've just done then is we've done the journal entry. These 3, land, building, and equipment, are all debited. They're assets. So assets increase with debits. So we've debited those 3, and then we've credited notes payable, which is our liability. Our liability increases with a credit. So when we purchase equipment for a note payable, that's what we're doing. We're debiting the assets and crediting note payable. So we have finished this homework problem. Okay, we're pushing out a question on Learning Catalytics where you get to do the same kind of thing. Push it out. Okay, so land, building, and equipment are acquired for a lump sum of $850,000. The market values of these, respectively means they're listed in the same order. So the land has a market value of $250,000, buildings $480,000, and equipment $180,000. What's the cost assigned to the equipment? So what cost is going to be on our equipment on our balance sheet? It's $350,000, not $250,000. Again, you're looking for the cost being assigned to the equipment, which what is it going to be on our balance sheet at? What are we going to journalize it at? The answer is not C. So for the 61% of you who have answered 180,000, that's not right, so you want to rethink your answer. You do have to do a calculation or 2 to get this answer. Okay, we're going to be moving on from getting answer entered. So we have the market values given to us. We have to figure out the cost assigned to the equipment. You've got about 5 seconds to enter an answer. So make sure you get an answer entered. Any answer will work at this point. Okay, the answer is $168,132. How I got that? First of all, total market value. I added the 250 plus the 480 plus the 180, got 910 as my total market value. Once I have my total market value, I could take the equipment market value, the 180 divided by 910, times the total purchase price of $850 to get the $168,132. So we've kind of come to the end of the how do we get the cost of assets. Now what we're into is how do we know if we've got some terminology here. How do we know this is a capital expenditure versus an asset? So that's where we're heading next. You want to handle that one? So next we're going to talk about this idea of a capital expenditure versus immediate expense. Okay, so let me explain what we're doing here. There's lots of terms to deal with here. So the terms that we need to know, we have a capital expenditure. And we also call that capitalizing or capitalized. A capital expenditure can be a purchase, but a capital expenditure can also be something we add on to our original asset. This example, Exhibit 7.2, deals with let's assume we have a delivery truck. Okay, so we have this delivery truck. Let's say we overhaul the engine on the delivery truck and we take it from having a 4-year life to an 8-year life. That would be considered a capital expenditure because it's significantly increasing the asset's life. If we take our delivery truck and we retrofit it to become a food truck, then the expense of doing that is a capital expenditure. When we talk about a capital expenditure, this means whatever the cost is of what we're spending, it gets added on to the cost of the asset. So it's going to go onto our balance sheet as an asset. The alternative is to say, let's just put it all in expense and it hits the income statement and reduces income right now. So with a delivery truck, ordinary repair. So let's say we get an oil change. That's regular maintenance. That doesn't extend its useful life. With normal maintenance, it's never capitalized. Okay, so we're using the asset in our normal business. We have ordinary repairs. So we have oil changes. We have new tires. We have lubricating it. We might make a repair to the transmission. Those aren't extraordinary. Those are just normal everyday things. So those get expensed. So they go on the income statement and reduce income right now. The big things, the extraordinary things, the things that significantly alter the life or the use get capitalized. And when we talk about capitalizing something, we are talking about putting it on the balance sheet as an asset and depreciating it over the life. So that has a much smaller hit on the income statement. So you're saying, oh, I have a $100,000 repair to make that extends the life of my delivery truck fleet, then that's going to get capitalized. But if you're talking about just to keep it in an ordinary working use, it's going to be expensed. So this is an example. 7.2 is talking about a delivery truck. These are examples. But we can also deal with a building. If I have a building, if I put a new wing on the building, that is a capital expenditure. Okay, so it goes on the balance sheet. On the other hand, If I repaint the walls in the building, that is an expense because it's ordinary maintenance. It doesn't change the use of the building. It doesn't significantly alter the life of the building. If I have the windows washed, that's normal maintenance. If I put in a new super efficient furnace to replace a furnace that's 50 years old, that's going to be a capital expenditure. So the reason I care is because capital expenditures go on the balance sheet and they're depreciated over the life. So the income statement hit is relatively small each period. If I expense it, it all gets deducted from expense right now. Okay, we're going to do a question real quick and then we're going to get into depreciation method. Good. Okay, Pat's recently paid to have the engine in its delivery van overhauled. The estimated useful life of the van was originally estimated to be 4 years. Overhaul is expected to extend the useful life to 10 years. What kind of expenditure is this? Okay, what kind of expenditure is this? Going to have to enter an answer. We recently paid to have the engine in the delivery van overhauled, changing the useful life from 4 years to 10 years. What kind of overhaul is this? What kind of expenditure is this? Revenue, capital, equity, or matching expenditure? 5 seconds left and we're going to close this. Okay, it's a capital expenditure. It significantly alters the life. Now, when we talk about capital expenditures, we have, when we make something a capital expenditure, so we have an asset, either we purchased it or we've added it on as a capital expenditure. We have this building sitting on our books, or we have this car sitting on our books. We have to depreciate it. And there's basically, we're going to be looking at 3 different ways that we depreciate it. So this learning objective is going to take us through the rest of today and a significant chunk from Wednesday. Learning objective 3 is the big one in the chapter. When we talk about depreciation, it is the process that allocates the cost to expense over the life. Okay? And what we're trying to do is we have the expenditure right now, but we're going to be using it over the next several years. So we want to match the cost of that expenditure against the revenues that asset is helping to generate. Depreciation expense is on the income statement, and just a reminder that land is never depreciated. Depreciation, when we talk depreciation, we are not talking about valuation. We are not talking about the value of an asset. Yes, over time our asset decreases in value. Over time we depreciate things. So they're going kind of in the same direction, but depreciation is not measuring the value of the asset. Depreciation is an accounting process to match, to kind of spread the cost of an asset over its useful life. Depreciation also doesn't mean that we're setting aside cash to replace it or anything. Depreciation has nothing to do with cash. So those are things it's not. So when we do depreciation, so we're going to start into depreciation. We're going to do calculations on Wednesday. So we're not doing any calculations today. Today what we're going to do is we're going to just talk briefly about all three methods. But before we get there, we need to talk about what we need to be able to do depreciation. So the items of information that we need to be able to depreciate. And the first item that we need to know is the cost. And we just talked about the cost. How do we get the cost of an asset? It's the purchase price, everything to get ready for use. That's kind of it in a nutshell. So we have the cost. Then we have the estimated useful life. The estimated useful life is the length of service expected from using the asset. The useful life is going to be given to us in years, in miles, in hours, something like that. Okay, for our purposes, well, in all of our circumstances in here, we will always be given the estimated life. So it's not something you have to calculate. It'll be given to you. Estimated useful life is how long the company expects to use it. It's not the life of the asset itself. For example, a company may supply its salespeople with cars. And when they buy a car, that company says, we are going to use this car for 3 years. And then after that, we want to get a new one because we want to present a certain image. So we're going to get rid of these cars after 3 years. So the useful life on that car is going to be 3 years for the company, but the car still has value to someone at the end of 3 years. So the useful life is simply how long the company says this asset is going to be useful to it. So estimated useful life is not the life of the asset itself, it's how long this company that it will be useful to the company. Okay, now we can have life expressed in years, that's typically it. We might have miles. In terms of aircraft, they rate aircraft for number of hours. So the useful life on an aircraft may be expressed in so many hours of flight time. So next up, we need the estimated residual value. So let's go back to our car that we buy for the salespeople. So we buy a car, use it for 3 years. At the end, we know when we buy it, we're only going to use it for 3 years. It's only useful to us for 3 years. But I also know when I buy it that 3 years from now, that car will have some value to someone. And I can estimate what that's worth at the end of 3 years, at the end of its useful life. And that's referred to as its estimated residual value. The estimated residual value is what we estimate that asset will be worth at the end of its useful life to us. So it's also called scrap value or salvage value, and it is the cash value of the asset at the end of its useful life. It is not depreciated, this residual value. And then we have this concept stuck down here at the bottom. Depreciable cost is the asset's cost less its estimated residual value. So how much we can depreciate is the cost less the residual value. We're never going to depreciate the residual value because we plan on getting that back. These are estimates. The useful life is estimated, the residual value is estimated, but we go on our best guess. Okay, so we need to know these three things. We have cost, estimated useful life, and estimated residual value. So those are the three things we need. Now what we're going to do is we're going to talk briefly about all three methods. We have 3 methods of depreciation. Companies will pick a method. Companies, by the way, can pick one method for their books and one for their taxes, and that's perfectly legal. So we'll talk about more on that on Wednesday. But these 3 methods, there's 3 main methods. The first method is the most popular common method, straight line method. This is the easiest method. Straight line method, basically, we're going to take our depreciable cost, you know, how much we can depreciate, divide by the number of years, and we're done. We get the same amount every year. So with this, an equal amount of depreciation is assigned to each year, and we're basically taking the depreciable cost divided by the number of years, and then we get this actual depreciation, the depreciation expense. So straight lines, very, very easy. Straight line is by far the most common method, the most popular methods that companies use for their financial statements. Okay, so if we're preparing our financial statements to release to investors and creditors, most common method is straight line. And it's nice because it's easy. You take the depreciable cost divided by the number of years, you're done. It's going to be the same every time, every year, except if we have a partial year at the beginning or end, but that's minor. Okay, so that's one method, straight line. Now the next method, units of production. Units of production we can only use in certain circumstances if we can measure the life of our asset by something other than time. So an example, I just mentioned aircraft. Aircraft are rated for so many hours of flight time, right? So we can have a units of production and we can depreciate based on how many hours we use this. Units of production, this is, I really would not want to write all this down because we're going to go through an example on Wednesday to look at this. This is a lot of writing, but it's the amount of depreciation assigned per unit of production, for lack of a better word. So example, if I have an aircraft that's rated for 1,000 hours and the aircraft costs $100,000, I would be able to take my $100,000, divide by the 1,000 hours, and get a depreciation cost per hour. So then every hour I flew that aircraft, I would take that much depreciation per hour. So you take the number of hours of depreciation times this depreciation cost per hour. So it's pretty straightforward, and the reason, so everything I wrote here is absolutely right, but it just seems so flat until we put numbers on it. So depreciable cost divided by the useful life in miles or hours or however we're measuring this to get the fixed cost per unit, and then we get our depreciation expense by taking that fixed cost per unit times the number of units produced each period. Units of production method can only be used in very specific circumstances. If I have a building, I can't measure that building in miles because the building doesn't move. The building doesn't really have a measure of life other than time. It's not like, well, here's how many people go through it or anything like that. So it's not going to work for buildings. On the other hand, copier drums are rated for how many copies. So you could do units of production for a copier. So it just depends on what your asset is, if you can use units of production or not. So we have straight line, very easy, divide by the number of years. Units of production is not hard once you make that initial calculation. It's pretty easy too. And then we get into double declining balance method, which is the method that's different enough from the other ones to give people pause for thought. So double declining balance method. First thing, most important thing to note here is double declining balance method is known as an accelerated depreciation method. Accelerated depreciation method means you get more depreciation expense in the first years of the life, less later. So you get a lot more in the beginning, less later. Straight line, you get the same amount all the way across. Accelerated depreciation methods, the reason we would want to use these on our taxes, because we get a bigger deduction up front, which gives us more cash to use. So taxpayers generally prefer accelerated depreciation methods on their tax returns. And we can use we can use one method for books and one for taxes, and that's perfectly legal. Okay, so double declining balance method, we're going to go through the calculations on Wednesday, but what it does is it says, okay, straight line depreciation, I take a certain percentage each period. For double declining balance, I'm going to take double that percentage times the balance. We have 3 minutes left, right? Everyone's like putting their books away. Okay, so we're going to be doing that on Wednesday. Double the claim balance. It's the only one that doesn't use residual value in the early calculations. Okay, so what we're going to do now is we're going to go to a question. I have a question in Learning Catalytics that Haley is delivering right now. Which one? No. It's ABC. Is it? Oh, I have. Yes. Is this it? Okay. So ABC Company purchased land with an old building that it plans on demolishing so it can construct a new modern building. The cost of demolishing the building will be part of the cost of what? The new building, old building, land, or land improvement. And this is our last question for today. So we're going to be closing it, but we're done. So if you want to, you can pack up now. And we'll be closing it in just a minute here. So okay, you have about 10 seconds left to answer this, so we're going to close it. Count it out. 5 seconds. And the answer on this one is, the answer is C, land.